Welcome to BBA Coffee Break, a new series of chats on topics ranging from industry trends to career advice. Hope you enjoy your first fresh brew.
Good evening, everyone. My name is Sohail Farooq. I am the CEO of Banking Book Analytics. And welcome to Coffee Break with BBA and its inaugural session. We are calling it Fresh Brew 1. Today, I have a great pleasure of bringing forward one of my former colleagues, also an illustrious finance professional, Eric Pascal, who is based in Singapore. Of course, a Canadian, traveled far out to Singapore. So, Eric, welcome to Fresh Brew 1. How are you today?
Good. Well, listen, thanks so much, Sohail. Thanks for doing this, and it's honestly my pleasure to be on the pilot of this program that I hope makes it to a long run.
Exactly.
Thanks again. I'm humbled.
Thank you so much, Eric. So, Eric, it's great to catch up with you. As you recall, the last time we met up was perhaps in London, England. About I would say a good decade ago, isn't it?
That's about right. Yeah, that's about right.
Yeah.
You don't look a day older, by the way. So
thank you so much. Thanks, and yourself, you're in good health.
Yes, so far so good. Knock on wood.
Yeah. And COVID has been treating you well, I would imagine. How is the challenge of COVID in Singapore?
Well, it's had ups and downs, as you probably know. So listen, I guess first, good morning, good afternoon, and good evening to your audience. If we're now formally underway, it was managed, I think, quite well in the beginning. There were a couple of issues in terms of some of the areas of society that weren't particularly kind of highlighted initially, but it's well under control now. So. It's we're going through kind of a slow staged reopening, as I think most places are. But the working from home, I think, has been kind of mixed results, at least for me. It's kind of hard to concentrate with people running around and screaming, as you know. I think, as most people know. But it has its advantages. So it's the enormous time savings from not traveling is very unique, and frankly it's very valuable. I'm in some ways a lot more productive, so it's a great balance.
Excellent.
So Eric,
I mean, I think COVID has been quite well managed here in Canada. The government stepped in early on. As you know that Canada shares a long border with the U.S. and it was quite big challenge to manage that border. And of course, there's people and families on both sides of the border. But all in all, I think we were quite successful, and the government did a terrific job, both provincial and the federal governments. So quite fortunate from that context.
That's good news. So you have a new finance minister now as well, from kind of recent news.
Yes. So, some casualties of COVID, of course, but I think overall, when I say casualty, that essentially implies the resignation of the former finance minister. But we still think that Chrystia Freeland has very big shoes to step in. So I'm sure she would. She's very from that perspective.
Has it affected any of the kind of outlooks in terms of the financial sector? I mean, I'm not suggesting there's kind of any negative interpretation, but what I mean is the kind of the obvious implications in terms of the management of COVID and what I would call the existence of zombies and hence credit issues that would surface on banks' balance sheets. And again, I think the big 4 or 5 banks in Canada are extremely well capitalized, and there's probably less risk of kind of systemic events. But it's something that I think between the ministry and the Bank of Canada and OSFI that people are looking at pretty consistently and deeply. Is that correct?
Yes, I definitely tend to agree. Of course, Uh, the program, the way it was launched, was actually to support ordinary Canadians, and
Yeah.
the support was quite timely in terms of allowing them to sustain their lifestyles at a reasonable level. There were 2 or 3 programs that were launched, and then in addition to that, there were also offers from financial institutions with regards to the payment deferrals. And quite frankly, when you look at the balance sheet of banks and, of course, other financial institutions, which includes credit unions, we see that there's a big incidence of payment holiday requests from individuals and households, with regards to their credit card payments, with regards to their mortgage payments, and so forth. The challenge that Canada faced was that going into COVID,
Mhm.
the society overall was quite leveraged,
Yeah.
and that's how, the Canadian finance system has been functioning. There's a lot of debts that makes its way into the households, one way or the other. So that of course posed a big challenge, and the way they addressed it is really by offering the payment deferrals. Interestingly enough, and since we both actually have done a lot of work in credit risk management, so interestingly enough, it is initially the payment deferrals had adverse impact on individuals' ratings as well as the corporates' ratings. But then I think that was sort of withdrawn, and as you would defer the payments, it gets capitalized into your principal and so forth, but would not have an adverse impact. I don't know how Singapore is treating this.
Yeah, so it's not. So I mean, the Singapore regime in respect of the what I think you're pointing at is the relevant regulation IFRS 9. In other words, is
Yes.
still has some time to run. I think until Jan 2021. So we have not as acute an issue, and I think frankly the regulator, the central bank, has made it a point that these deferrals will not be an automatic classification to stage 2 and effectively creating an immediate or short-term provisioning issue for banks.
Okay.
So
Okay.
that's been explicit. I think they came out and said that in support of
Mm-hmm.
these types of measures, and there are quite a few deferment of mortgage payments and so on. So.
Mm-hmm. So, go ahead. Yeah.
Yeah, so I think that's one thing I wanted to probe a bit in terms of how it was being dealt with in Canada, because I remember OSFI in March, they lowered some of the capital requirements for banks, and also they changed or suspended, I think, some of the changes that were meant to take place in mortgage stress testing as a result of COVID. So are these? I mean, what's the view in terms of the analytic community? Are these measures potentially creating what I would call retail level zombies? And your audience
Yeah.
knows what zombies are, I assume.
Yeah.
For all analysts.
Yes. Exactly. So that's a very good point. So there are 2 sides to this. I can parse this question in 2 parts. The first part is essentially for the insured mortgages and insured debt. So from that perspective, the top insurance provider, which is CMHC in Canada, has authorized a 6-month payment holiday. And then the uninsured, with regards to the uninsured mortgages, they are following the same sort of 6 months would expire somewhere around end of September, and there is likely extension to that. But the problem that we can foresee that would emerge is really the creation of these zombies or sort of uninterested parties who would not really be making the payment as a result once these sort of flexibilities are removed. And that's going to be a big challenge. So there is a lot of data that is being pulled together. There is a lot of data that is being analyzed, and we are looking into, at least from the corporate perspective, especially in in hotel and tourism assets with the balance sheet of banks, they're very badly damaged, and there would be some programs that would be required really to facilitate and perhaps restructure those debts. But with regards to the individual and household payments, you're right. There may be a snowball effect that can emerge towards the end of this payment holiday.
So, one thing since the A in BBA is analytics, right? So one thing I wanted to get from you and perhaps your audience was a sense of whether or not people are thinking about extending the depth of analytics into early warning for credit.
Exactly.
Right? Is that a topical discussion? I mean, I know, we've been at that for 40 years, right, to try to create early warning signals in credit. But now it's especially acute if you think about the public markets. So in the bond markets, the dominant form of growth in terms of non-bank or non-financial issuers has been in the triple B and non-investment grade, the high yield segment of corporate bonds. And what's disturbing about that is even when you look at the EBITDA interest coverage numbers for the triple Bs and triple B minuses, there's a great dominance of under ones, under that ratio being under one. So that's quite worrisome, because once you dive into non-investment grade, it's exponentially worse. And if the combination of these under one EBITDA interest coverage and high yield issuers are greater than 50-60% of the total corporate bond issuance, then there is potentially a significant issue that may lead to systemic balance sheets in the financial system. Now, having said that, the interesting component of what the asset repurchase programs from the Fed and BOC have done is starting to delve into let's say riskier portions of the curve, and so I'm a bit ambivalent. That's why I'm asking this question, because on one hand, I can clearly see there's a potential bubble in terms of non-investment grades that are just going through perhaps tremendous credit stress and are being supported by government measures. And when the measures disappear, these people are, these companies are in quasi default or technical default. So the question really is, does the analytics account for that phenomena? I guess part one. And part two is if the BOC is buying a lot of this debt, and that's I don't have visibility in terms of how far down the credit curve they've gone. Maybe you do. If that's the case, then is the central bank then the lender of last resort, and are they holding the what you'd call the residual tranche of a securitized credit?
Yeah. That's so it's a very important question, and from an analytics perspective, I think one of the things that we had to deal with, especially in our engagements with clients, and for those clients who are actually using some of our software, is that there's no quick fix to developing an early warning signal, and I'm talking about debt that is privately held. Of course, when we are talking about the public floats and the publicly held debt, Bank of Canada has done a terrific job there with regards to the disclosure on the purchase of debt. I'm not sure to what extent that disclosure is being made on the public debt itself, and how big the balance sheet is getting. But if it were to be considered that debt to EBITDA or interest coverage ratios were to be looked at as potentially early warning signals, and from what you described, they're quasi or below one, then of course we are actually faced with a very, very challenging situation, and this could really implode itself over the next 12 to 18 months, right? Similarly, for the private debt, we are looking at. Go ahead.
No, sorry, I'm sorry. Just to be clear, I'm not suggesting that EBITDA interest coverage is an early warning indicator. In fact, if anything, it's lagging. But the idea is to look at some of the dimensions around what are the payment flows, if there is that granularity, and perhaps if a bank is lending to a borderline credit between investment and non-investment grade, they would potentially have access to some of that data if it's a customer that is already a depositor or a customer that transacts with that institution.
So I think we can divide the emerging early warning signals in two areas. The one is really around what you would describe the stress situation that these individual issuers are facing, and that stress situation can be manifested in two forms. The first is whether or not it's a complete capitalization of principal and interest, P&I capitalization, in other words, complete payment holiday. The other could be that they would continue to make the interest payments, but not really make any principal payment, and have that principal being capitalized into and into the overall sort of leverages itself. So then we're looking at the liquidity side of it. That once you're holding these securities, can you really use those as collateral for interbank borrowing? If you have such structures in place, are these securities allowing themselves to be used as collateral? And then what kind of haircut would be associated with such a collateral? So, that's the liquidity side of the equation. And I personally think that, at the moment, the analytics is not doing a great job because as you know that, more and more data starts emerging, and then, it'll allow us to start developing the the sort of these finer points, and their impact. So that's the idea there. At the privately held debt, which is on the balance sheet of banks and credit unions and so forth, we are looking at about 30 to 40% payment deferrals, and so a major chunk of portfolios has gone into payment deferral. So anywhere a range of 10 to 15% to half of the lending portfolio is in payment deferral mode, and so that's the sort of I would say the extent of this payment holiday, especially in GTA, where as you may know, that a lot of the sort of debt resides and is domiciled privately held debt, which kind of course leads to the securitized debt itself. So yes, the challenges would be there, and we are unable to really identify any emerging risk because limited data is there with regards to the liquidity side of the equation. But of course, from the credit side, it's becoming quite apparent that it can snowball into something major if it is not managed adequately.
Right. But in terms of let's call it retail credit, how have institutions, and let's use credit unions as an example, how have they started or enhanced their adoption of what I would call deep analytic methodologies that look for either alternative sources of data. I mean, I know that's a buzzword, and what I mean by that is really not necessarily looking uniquely at social media and broad-based sets of information for which you need consent, but a number of different factors that would propel or triangulate into cash flow or credit dimensions. All right. So there's a few things. I mean, in the fintech world, that's pretty much what people do to lend to the unbanked, right? To banking the unbanked, and looking at white space for financial institutions, at least in this part of the world, who have traditionally never lent to SMEs on an unsecured basis. Right. So they need different methods. They need ways to quantify that credit. And so what I'm asking is, are those different ways and new forms of, kind of deeper analytics useful in respect of, having a look at these types of credit issues in Canada?
That's a very good question. So yes, I think the awareness is beginning to sort of take hold at the decision makers level, that this is the way to go, especially in a crisis situation such as COVID-19 that we are in. To give you some examples, when you have a portfolio which is in abeyance of payments, of course, you have to have some methodology in place. So what is their recourse? We're not talking about the commercial here. We're talking about the private debt or retail debt. And with regards to the retail debt, the analytics that is currently being practiced is based on certain important questions. So, such as, what is the health of my portfolio going into this crisis? So, how was it in March of 2020, April of 2020? And what was the sort of distribution of my rating grades? What was the distribution of my beacon score? And those type of things. So those are some important questions that need to be answered. What percentage of that was in super prime, in prime, and in subprime? Let's just put it that way, right? And this would sort of give you a bit of an idea that, what can you expect, let's say when we come out of this crisis, in about 12 to 18 months, So that's the question number one. The question number two then could be that, hey, you know what, if this situation were to prevail for an extended period, how would my balance sheet look like? What would be my capital position? And what kind of analytics is out there that would allow me to actually run or develop such models? This would help us understand the impact of these things on our balance sheet. So, so based on this sort of, kind of a very logical approach, some of these answers can be developed, and some methodologies are out there, as you know, Eric. Stress testing is one of them. Scenario-based stress testing being a very, very important part of that. So that's really what BBA excels at, in terms of scenario-based stress testing, in terms of providing the liquidity future forecasts and things like that.
Yeah, I think that's quite useful, and I think that's where this is, I think, a relevant discussion, because I'm also kind of keenly aware that there's probably quite a bit of emphasis on some of the perhaps some of the real estate related personal debt, and I think some of the fears that were expressed early on was the potential damage from COVID, from a let's say a dramatic drop in economic activity, for lack of a better term, that would cause a drop in real estate prices, and certainly in the hubs of GTA and Vancouver, right? And the effect that potentially would have in relation to LTVs, and hence kind of the balance sheet strength and the value of the credit on some of these lenders, especially if you think about the debt equation, as you've highlighted early on in this conversation, that households in Canada tend to be quite highly levered. And so if people have high credit card debt and they've got mortgages to pay, and guess what, the collateral value of their property's gone down. Now, from what I understand from the data, that hasn't happened. In fact, it sounds as though quite the opposite has happened. That for whatever reasons, GTA real estate has done better. But it was one of those things that I think when you look at the value of collateral, when you think about it, risk weighted assets, right, RWA, it's such a vital component, and clearly feeds into the LGD calculation. But what I was kind of wondering in terms of the early warning systems is whether or not there is value in trying to take apart an individual's kind of monthly payment and obligations, and whether or not there is a kind of a preponderance for views in relation to retail in particular, only paying one or two of their obligations and letting things slide. So again, one of those indicators would have been something like the amount of credit card debt on banks' balance sheets. And there again, what I've heard and what I've seen and read is that actually the credit card balances have gone down, not up, in most banks. Is that correct?
Interesting. Yes, yes. So I don't really have a handle on that data, on the credit card data. But what I do know that, the real estate has been quite resilient, both across the entire country, in terms of the collateral values that it provides. So if you were to actually look at the emerging crisis with regards to the payments and the potential for foreclosures or potential to draw down further on home equity loans and lines of credit, so that I think would still be there as we come out of the crisis. And if the banks were to actually undertake extended credit view and decide on that basis, then what we are trying to do here is we're trying to actually increase the amortization period, unintentionally, and that would allow us to sort of, perhaps manage ourselves out of this crisis. So that's the that's probably from the retail side. On the corporate and commercial side, I do think that there are certain sectors that are going to be badly damaged coming out of this crisis for a number of years to come, and there may be some government programs to actually sponsor and perhaps assist those sectors. So that's the idea there. Eric, as we come to the conclusion of this conversation, what we would like to do is also sort of leave a message for the aspiring finance professionals. Those who are still in colleges and schools and universities. And what kind of career advice do you have for these young kids who are looking at you today and, try to sort of picture themselves 15 to 20 years from now, uh, and, and seeing the things exciting things that you've done. We've shared your LinkedIn profile with our followers as well. So what kind of message you would like to give?
Well, look, I think, in my case, I was guided, very early on by the desire to make money, to be honest, and to be kind of very actively entrenched in capital markets. The world has gone, basically 180 degrees and kind of moved away from a lot of the paradigms that I grew up with. So I think the message is, be flexible in terms of what you're seeing and what you're doing. Now, I know, it's easier said than done, and people endlessly talk about the HR function and how financial institutions are now changing the way they're hiring people. They want breadth. They want people that think out of the box and so on. But fundamentally, they still want people that fit into, they want square pieces that fit in square holes. So, what I mean by flexibility is you have to have a sense of agility. And, again, I hate to use that term. It's associated with a form of IT engineering, but it's useful. It's very useful to be able to adapt to changing circumstances, and that's what I mean by flexibility. So read the tea leaves and be able to adapt to different changes where skill sets may have to adapt with the market, with the environment.
More and more people are questioning the importance of a formal university education. As you get out, back then when perhaps you and I embarked on our careers, MBA was probably the go-to thing,
Yeah, that's
interesting.
interesting.
What value does MBA bring to the table?
Well, I think that's a good question, honestly. I do believe fundamentally in terms of undergrad, you've got, there's two schools of thought. There's the liberal arts kind of US view that, you do whatever you think is going to be a discovery tool to figure out what you really want to do. And then you focus on, kind of the masters of the, post-grad education in terms of focus on some specific topic or a specific field. I think that in finance, you need to have a a fundamental base, right? That will include things like accounting. It will include things like finance, Modigliani and Miller, Breely and Myers, Fabosi, capital markets. You need to have that foundation. So when I say be flexible, yes, I think you need to kind of play along with how the environment is changing, but you need to have that base, because fundamentally, whether you're running a FinTech or you're running an innovation part of a bank, as an example, that deals in FinTech. I found out a couple of weeks ago that something in the order of 50% of my graduating class from my U of T BCom is working for RBC in some form of data analytics or innovation work. So, very interesting stats, right? But I think that the point is that basis is always going to serve you well, because the ABCs of any business is accounting by definition. There will always be forms of corporate finance and creating ways to leverage either credit, market liquidity risks, and repackage them in different forms. So those skills, the ability to tap capital markets and understand them, economics, macroeconomics, the flow from the fiscal and monetary policy easing and accommodation that you described as well as a result of COVID. What are the impacts of those measures on individual, corporate, SME balance sheets, and fundamentally to the lenders that support the whole financial system? So all of those skills are the base. I think what people do is that understanding, and then they can be agile in terms of where they applied or how it's applied.
Excellent. Well, Eric, thank you so much for making the time and chatting with us. Fresh Brew One, and look forward to staying in touch. And I wish you well and your family. Take care. Have a great rest of the evening. Thank you so much. Bye-bye.
Same here to all of you, our listeners, families, everybody. Stay safe, and it's my pleasure. And I hope to hear and see more of Fresh Brews. Yes.
Thank you so much.
In the future.
Thanks
for the honor to be the first.
Great day.
Thanks, guys.
Bye-bye.